Welcome to Money in a Hot Minute, where I answer your money questions quickly. Today's question comes from Anushi, and she asks, I have income around $70,000. I have student loan debt of $150,000 at 7% interest. What should I invest in? Or should I pay off my loans first? This is a great question, and the best answer to this would require more information about your situation, but here are some general points to consider. 7% is a pretty hefty interest rate for a student loan of that size. To put it into perspective, you can get an interest rate for a 30-year mortgage on a $150,000 home for around 3% right now. So your student loan is like having a house but paying over double the interest over time. There are considerations here like, is this a federal loan that carries benefits such as an income-driven repayment plan, pausing of payments like we saw during a COVID crisis, or possible forgiveness? Depending on how your loan payments are structured, particularly with income-driven repayment plans, you end up with a lower payment overall. A downside of this is that your student loan can experience what's called negative amortization. This means that the payments you're making aren't enough to pay the interest owed and the principal amount. This is why many people feel like they pay and pay and pay on their student loans and the balance barely budges. However, you may be on a plan that will allow for forgiveness of the balance at the end of a certain period of time. Generally speaking, you want to start investing as soon as you can. If your company offers any kind of retirement plan match, you'll want to be taking advantage of that at a minimum, while at the same time focusing on getting that student loan debt paid down. But there comes a point where what you're paying out in interest for your student loan could take away or kind of give you at a break even in regards to any return that you may receive on your investments. The average return of the S&P 500 is around 8% over the past decade after taking into account inflation, and your student loan interest rate being paid out at 7%. So that's cutting it close in terms of there being a small margin of return overall of only about 1%. Another thing to consider is refinancing your student loans to a private company that can get your interest rate down. But with this, you lose the benefits of having a federally backed student loan. It could make financial sense though, depending on your situation. The main math that you'll want to do is 1, how much interest will you actually pay over time on your student loans if you keep things the way that they are? Take into account any type of forgiveness and any taxation of any forgiveness down the road. 2, how much would your investment account be if you ended up investing your extra income versus focusing on paying down your student loans? Is what's going out more than what's coming in? If so, maybe focus on the loan or refinancing. Also, don't forget that there is the possibility to balance both paying down your student loan and investing depending on the circumstance. That's it, Finance Fam. If you have a question that you'd like to see answered, go ahead and put it in the comments. I'll see you in the next video.